Okay, before we jump in for this week, I should give you some notice on the applied series. The current price right now is 220. That increases on the 15th. So if we go down to the schedule down here, right now it's 220 for the full program. Starting September 15th to February 28th, it does increase to 320. The full price will eventually be 650 for all 6 modules. But they'll all be priced independently. You can pick out whichever module that you want. But that 220 ends on the 14th. So what is it today? The 11th. So as of the end of Wednesday, that 220 will be gone. Starting Thursday, it'll be 320. The options course, here are all the modules that you'll eventually have. The applied options course is already up. And next year it's going to get an upgrade. I'll be upgrading it a little bit more each year because there are a few other things that I want to add to it. But it's fairly comprehensive. But I can see where I can make this a little bit better, add a little bit more detail here, add a new chart over there. So it'll get some updates next year. The sector studies have really grown. And I think that I had it light to begin with. But it was supposed to be an overview of all the 11 sectors of the economy in terms of the representation in both the MSCI All Country World Index and in the S&P 500. And I've got consumer discretionary materials and consumer staples done, and I'm on financials. But financials are a little bit different than most other sectors because it's the industry groups that you have to pay attention to, not so much the sector. You can say some things about the sector, but you got to go into detail with the industry groups. So then I thought, well, hang on a second now. Why don't I do that for all of them? Why not have a description of every sector? Then the next round would be, let's go down to the industry group level, then the industry and the sub-industry level, which is a lot of work. That on its own is a 100-hour course to go through all of those things. So I'm using external writers, people who have years of experience in each sector. And I've already got 2 down so far, one for financials, one for healthcare. To show you what I mean by that, let's have a look at the financials right now, which is what I'm working on. The sector is called financials. But within the sector, you have industry groups. These are the 4-digit codes here, the 4010, the 4020, the 4030. You have banks, diversified financials, and insurance. These are industry groups. Within industry groups, you have industries, which is the 6 code names here. The banks, thrifts, and mortgage and finance are within the industry group. These are industries, and then these are sub-industries. Well, I'm doing the analysis for the sector. You know, what drives the sector? When do we want to be in the sector? At what stage of the business cycle is the sector more important? But when you get to financials, it's not that clear cut. Because there are 2 drivers. It's the whole sector is interest rate sensitive, but it's also GDP sensitive. However, there's an interaction between them depending on what industry group you're in. So I think, well, I can't just stop at the sector. I have to go to the industry groups. And then, of course, you know, I'm never happy sitting still. I say, well, if I'm going to do the industry groups, why don't I go down into the industries and then the sub-industries? And why don't I do it for all 11? And that's when it occurred to me that I'm going to need writers. I'm going to need industry experts in each of these fields and hire them on as authors or co-authors. So that's what I've been doing. So this section alone, this sector, is going to be a 2.5 to 3 year build out because it's going to get, we're going to move from the sector level and in time we're going to move down into detail on the industry groups. From the industry groups we'll iterate down to the industries. From the industries we'll iterate down to the sub-industries. And then what we'll be missing there is the bottom-up part, which is, if we look at our courses, we have the applied, the sector studies. There's your applied bottom-up. The applied macro and top-down, there seems to be some confusion that that's economics. Economics is only one part of it. Economics will help you determine where in the business cycle we happen to be, and it's a lot of indicators, leading, coincident, and lagging indicators that help us determine where we are. And then there's different markets that we look at and how they're doing in relation to others. That's called intermarket analysis. That's the big part of top-down analysis, is intermarket analysis, which is It's billed out as part of technical analysis, but I find it to be a more fundamental version of technical analysis, and I like intermarket analysis. I'm not averse to that. And then this ends with futures and options and applied forex. All of these will be priced separately, by the way. But if you buy the full access, you get the full program. Even though these modules are not developed yet, as they're developed, they automatically just show up in your video section. So you just get them as they develop, and all of the updates, you get them as well. So no further fees as content is added. You get all 6. So I guess my message here is on the 15th, it goes from 220 to 320. But there's another module that's almost fully complete by that point in time. Okay, let's get to our week ahead here. Okay, let's have a look at what happened in the bond market and the equity market last week. Equity market, we saw 150 points up, 160. Started the week at low 39, low 39s, ended 40, 60, 150, 160 points up. Look at our year-to-date highs in yields. September 9th on Friday, all the way out to the 3-year and the 30-year hit the year-to-date highs. The lower end of the curve, or shorter end of the curve. Up here we can see making room for what is most likely going to be a 75 basis point move. It pretty much has to be 75 basis points. 50 of those probably to satisfy their mandate, 25 to send a message to the market that the Fed is not going to pivot. If they go 50, they only fuel that very narrative that caused them, that caused Powell to do his 8-minute Jackson Hole performance. So they pretty much are cemented in for 75. I've even heard the possibility of 100 basis points. It's, on the fringes, but there is the possibility of 100 basis points. But pretty much 75 is being priced in now. The big question that I've heard asked quite often on Bloomberg, and especially on real yield, is have we seen the high on the 10-year for the year? And the answer is almost unanimously yes. This was set on June 14th at 3.49. Well, we're at 3.33. 16 basis points below that, and we think that we have another probably 125 to 150 basis points increase in the Fed funds rate between September, November, and December. That we're not going to squeeze another 16 basis points out of the 10-year. I don't think we've seen the high on the 10-year for the year. Our next meeting, 21st, 10 days from now. Yield curve remains inverted. This is 66 days now, over 2 months. That it's inverted. Not as inverted as it was previously. I think we got into an inversion of 43. We're inverted at negative 23 because the long end of the curve has been moving up. Typically, inversion is solved by the 2-year coming down. That would be consistent with the Fed pivot, which the bond market has pretty much gotten. Now, it's not going to happen. There's going to be no pivot. I can say that with absolute certainty because a pivot looks like this. You raise, you get to a point, and then you pivot. If you raise to a point and then you keep it the same, that's not a pivot. That's a pause. So if you want to talk about a Fed pause, yeah, I think that should be the narrative, is the Fed pause. That's the next thing we should anticipate, is the pause, because a pivot means you just pivoted in one place. Once you have a pause for a while, and if you do start lowering rates, that's a drop in rates. That's not a pivot. That's just a drop in rates. So there is no pivot. There's going to be no pivot. If anything, there'll be a Fed pause, and then the bond market is starting to think in terms now about when is the pause going to happen and for how long. The Fed balance sheet, week ending September 7th, is down 4.22 billion. This, by the way, just to put it in context, this is $4.2 billion that is no longer available to go into financial assets. So if we think about how much valuations were pushed up or how much prices were pushed up, this is $4.2 billion less that can do that wherever that $4.2 billion happened to have went. It's $4.2 billion less to do that. The balance sheet sits at $8.3 trillion now. Next month, we already know they're going to hit their $60 billion in treasuries. Through a combination of coupon paying bonds, which are capital market bonds, and since they won't get to 60 billion with that, they will use some T-bills, allow some T-bills, but they will hit their $60 billion cap for mortgage-backed securities. The cap is 35 billion, but we are already told that they're not going to hit the 35 billion. So for mortgage-backed securities, the difference between the coupon-paying bonds and mortgage-backed securities is these are bullet bonds, which means you get coupon, and then you get your principal all at one time. Whereas mortgage-backed securities, you get principal plus interest on every payment. They're called fully amortizing bonds, which means when you get your last payment, it's all done. When interest rates go up, the speed of prepayments drop because refinancings drop. And we've already seen the refinancing index in mortgage applications at multi-decade lows. So refinancing goes down, so the speed at which you collect your prepayments, this is called the PSA, the speed slows down a lot. And when the speed slows down, you're getting just the principal component that is in the mortgage payment and very, very little prepayments, which increases the duration of these bonds. But because the principal payment is so low, you don't hit your $35 billion cap. As mortgage rates start to drop and as refinances start to increase, your principal plus your prepayment amounts begin to increase towards the cap. So when we see mortgage rates stabilizing and maybe even dropping, when you start to see mortgage applications increasing and the refinance index increasing as well, then that means that they're more able to move closer to that 35 billion. If we look at OAS credit spreads, investment grade pretty much unchanged week over week. High yield pulled in 5.5%. We're back under 500 basis points. In investment grade, the top to the bottom, 0.85 to 1.86, and in high yield, the top to bottom, double B here, 3.21 to 11.61. All of them showing a decrease in the spread over the week. There is a consensus in the credit market. When you say the credit market, that means the bond market for risky bonds, credit market, that bonds are simply not cheap enough yet. So those spreads have to widen a little bit more, but they've all come in over the course of the week. Let's look at the probability of the rate hike that we're going to see in 10 days. Last week, the market had 43% probability at 50, 57 at 75, almost even odds, just slightly in favor of the 75. Well, that's not the case now. 91% on the 75, just 9% on the 50, just so that you have a toehold in safety, where if they go 50, you could say, I didn't say 100%. See, there's my 9, so I am partly right. I think it's 100%. Both in terms of fundamental and psychological, is fundamentally you have to raise rates because you still have an inflation problem, and you're going to have to address that. Rates do have to increase because on the short end of the curve, the real rates are probably still negative. If you annualize just the core PCE, you get to 4%. So if we're looking at the 1 month, because I took the 1 month and annualized it, you get the 4%, you're at 257. Just with that simple calculation with core, your real rate at the short end of the curve is still negative. And you got to get real rates at the short end of the curve positive. That's the thinking, so that you raise rates and hopefully inflation comes down at the same time, and it works both ways. So if you're raising rates, you're raising this closer to zero. If inflation expectations come down, it raises that closer to zero, right? So that the spread between those two narrow. So you got to raise, fundamentally you have to raise rates, but psychologically you can't go 50 anymore, because the whole Fed pivot story was based on they're going to go 50 and then they're going to go 225s and they're going to be done, and then by March they'll be cutting rates. That was the whole pathway on the Fed pivot. If they stay on that pathway, that story comes back. which means, as I explained last week, the more the market pushes back against the Fed by pushing prices higher, we saw that the components of financial conditions, the one that the market is most in control of is the leverage ratio, which is ratios of debts to equity. Well, if they push up prices, they're pushing up the equity values, right? And if they do that, that's easing financial conditions. The Fed's only going to have to continue to raise rates for longer and even go even higher. So I don't see how they can't go 75. They have to get off the pathway of the narrative that the market set to really send a message to the market that we're not on your path, we're on our own path. So get on our path or you're going to get hurt. I can't see how they can't go 75. I can't see how if they go 50, that's a mistake. That would be a mistake because, well, they're going to have to go higher than 4.25%. They go 50, yeah, you can probably see rate increases till you get to 5%. They got to go 75. I can't see how they get it done any other way. So I think 75 is in. And if you look at this zone in here, 3.08, 352, 367 on the 3-month to the 1 year, the market is really making way for 75. So it's not as if the committee has to say, well, what impact will 75 basis points have? They already know. The market has already done it, and the equity markets rallied 160 points for the week. While the bond market did it. Now, a lot of that heavy lifting came on Friday, but the market rallied into Friday while real rates were increasing on Friday, while nominal rates were increasing on Friday, the market rallied into Friday. So the Fed has its answer. We can fill the gap. The market has already moved the 75 basis points for us at the short end. We're not really pushing rates. We're just filling in what the market has already done. I don't see how they don't go 75 basis points. Year end, we have a new rate at year end now over the week. Now it's pushing. There is some probability of getting to 4.5. The 3.5 is gone. That was there last week. That is now gone. The belief is, well, we're going higher than 3.5. There's zero probability of that happening. Low probability at 3.75. Most of the weight is on the 4%, 70.9% that we would end the year at 4%, which means a 75, a 50, and a 25 would get us to 4%. 4.25, you have 20.8, and 4.5, you do have some weight on it now, 1.5. We do have CPI coming on September 13th, 2 days from now. It's going to move the market. It's going to be Tuesday at 8:30. So Monday, I don't know is going to be of anything of any value. I think there'll be a lot of expectation that headline is going to be low. And Monday, I think you'll have the Fed pivot story back for a while. The Fed's going to pivot, comma, they're going to have to. The Fed's going to pivot, comma, they're going to have to. And we'll see what happens on Monday. Tuesday, when that number comes out, market's going to move. I just don't know which direction it's going to move, but it's going to move. They're not going to just shrug their shoulders and say, nothing here to see. It's going to move. With the schizophrenia of the market now, because I think I've never seen a market so completely divided and evenly divided between we're going up to we're going down. I haven't heard anyone say, I think we're going sideways. I might be the only one who thinks we're going sideways for a while, which is probably wrong because markets just don't want to go sideways. If we're not going down, we must be going up. If we're not going up, we must be going down. Tends to be the story in the day. So, it wouldn't surprise me if the report comes out and we rally 100 points and then Wednesday we give it all back. Or, the report comes out and we sell off 100 points because it came in hotter than expected, only to get it all back the very next day with the Fed's going to pivot anyways, is a narrative, If it comes in lower than expected, we'll rally, then we'll sell off the next day saying, the Fed's going to ruin the economy now. And if it comes in higher than expected, we'll sell off and come back the next day with the Fed is going to pivot. So there'll be some narrative out there. So my forecast is volatility. That's it. And whatever volatility we have, I know there's a trade at one end of that volatility or the other. I just don't know what it's going to be, so I don't know what trade I'm going to make, but I know there's going to be a nice trade based on that report. And we're going to spend some time looking at what we what we think that we can expect. For now, let's go to the real rates, and there's a little bit of a problem with the equity markets. All right, here are our real rates at the top. Year-to-date highs. All happened on Thursday and Friday. Only the 30-year was Thursday. The rest happened Friday. All real yields hit their highest for the year on Friday, on September 9th. When we look at valuations of assets and trying to come up with a fair value for an asset, the most common method is discounting all of the future cash flows. In fact, any asset is typically priced by the present value of all the future cash flows. So you have a series of cash flows over time, and each one of them is discounted by some risky rate all the way out into the future. And this risky rate, these are usually nominal cash flows, and these are usually nominal rates. In the nominal rate, you have a real rate and you have an inflation expectation. This is a very correlated component with the cash flow, because if you have higher inflation expectations, companies that can typically raise their prices. Companies that can't raise their prices, but maybe not as much as they like to, but prices go up, which means cash flows go up. So you can have a rising nominal discount rate and a rising numerator, and the effect on your present value is kind of hard to figure out what it's going to be unless you actually forecast out those cash flows and those rates. A cleaner way to do it is say, well, let's remove the correlated component. Let's get rid of inflation expectation altogether, and let's not have nominal cash flows. Let's just turn them into real cash flows. And real cash flows is just based on what's the price today, and you forecast out quantity. And you use today's price with quantity each year, and you discount it at a real rate plus some spread to reflect the fact that they're risky cash flows. And it's the nature of the cash flows that will determine the spread. Is it, cash flow to equity or cash flow to the firm? Cash flow to equity, you'll discount at a cost of equity, a real cost of equity, and cash flow to the firm, some weighted average cost of capital. So we have a cleaner relationship here, and the relationship is if real rates are going up, then present values must be going down, so valuations must be going down. Well, throughout the week, we're hitting the highs on real rates for the week, yet valuations got richer in the market. And what made me convinced on Friday that this was nothing more than the retail market. I don't think the institutional market was playing along on Friday. I think it was just retail market trading. Is I look at Bitcoin as a gauge to whether or not I believe the rally. Bitcoin was up 10%, so I said it's a fake rally. This is not a real rally, for the simple reason that the bulls are still playing by the same playbook. And that's not how new bull markets are formed, by continually playing by the same playbook that was in play during the last bull market. So being that the retail trader is usually, or the retail investor is usually the last one to change their strategy. They usually stay with a strategy that worked when they entered the market. So if you enter the market in a bull market and you're riding a wave, you keep doing that. And if you have a correction or a bear market followed by another bull market, you keep playing the same playbook because it's the only playbook you know, and it's very rare that the same playbook works in the next bull market. So when I see the same things coming back, I say, well, this is the same playbook. So this can't be real. This can't be new. It doesn't have any of the flavor of a new bull market whatsoever. It cannot be. So I used a new trade for October using SPY, and I'll share that with you in a while. It's a nice straddle that had some good premium to it. Now, if we had the rally last week and Bitcoin stayed at its price or even sold off some more, I would say, well, that's interesting. Now that's interesting. They're abandoning the old playbook. And if I saw that, the meme stocks were selling off and the high PE stocks were selling off, but the broader market was increasing, then I would have said, okay, this is something interesting. I'm not going to add any short positions on the index. But when I saw that, I added short positions on the index. Look at our break-even rates here. The 5-year at 2.51, the 10-year at 2.42, which is lower, which makes the 5-year forward even lower at 2.33. Inflation expectations coming down. I'm skeptical that there's a lot of information in here. One thing that I will point out is it is consistent with real rates rising that you would have inflation expectations dropping. It is consistent. Let's move on to the housing market, and here is some super interesting stuff. Here I see a turn in the housing market, and I see a turn primarily not in demand. We've already seen demand drop off, and the thinking was supply is just going to continue to increase, but it's not. I know of a couple of people that are looking for houses, and I was suggesting, with the recent Bank of Canada move, probably the next 30 to 60 days will be your prime time for buying a house. I don't know that housing prices are going to come down 20-30%. I don't think you're going to get that. You've got a softening in housing prices right now. I think this is probably as good as it's going to get in most markets because we have a housing shortage. And I'll talk more about that housing shortage shortly. And the answer I got from both of them was that, it probably would be a right time, but supply is shrinking. There's nothing out there to buy, which seems rather odd because you would think, well, supply would be increasing, right? But the agent for one of them is saying that some people are taking their house off the market completely because they just won't take these lower prices, even though they paid less. So you have some people who paid $700,000 for their house, and had they sold it at the beginning of the year, they could have got $1 million. They did this. They bought it for $700,000 last year. They could have got $1 million, but now they're going to have to settle for $850,000 to $875,000. They don't see it as making $150,000 to $175,000. They see it as losing $125,000 to $150,000. So they're like, I'm not going to take the loss. Meanwhile, they don't have a loss, but they're anchored to what they could have got, and they're not going to sell until the prices get back to this point. You're actually seeing supply coming off the market. Now that's anecdotally. Anecdotally, am I saying that right? Sometimes I have trouble with certain words. We'll look at Realtor.com. They have their August report up, and when I saw that, I thought, okay, now I'm interested in housing because I think we're seeing the turn. There is an imbalance in the market. There, even with demand destruction, there is still not enough supply for the existing demand. But we're also now seeing supply destruction. And so I would say the market is in balance right now, and the balance in the market is an imbalance. In other words, it's not going to come into balance where supply and demand are equal. It is in balance right now. It is in an equilibrium right now where supply is far less than demand, and that's just the way it's going to be. There was an interview last week with the housing secretary on PBS, the PBS NewsHour, talking about the housing market, and she said that there is a chronic undersupply of housing in the market right now. She was talking about the billions of dollars that the Biden administration had pledged for affordable housing. She used the number 1.5 million new houses have to be built every year just to meet the combination of population growth and household formation. I was using the number 1.2 million per year and coming up with a shortage. We're not even near the 1.2. She's using the 1.5, which makes it even worse. So it's interesting that we're seeing the turn of events that we're seeing, and I'll walk you through it here. Let's look at mortgage rates. Now keep in mind what real yields have done over the course of the week, and nominal yields hitting, many of them hitting the highest for the year. The 30-year fixed 5.97, last week was 6.02. You can call that unchanged. I mean, when it's 5 basis points over the course of the week with all that trading, I don't know that there's a lot of information, but the high was 6.23 on September 1st, and it didn't push towards the high even as real yields were pushing towards the high, 5.97. The FHA 5.38 versus 5.32, again 6 basis points. I don't know that there's much information in there. The big information is they're just not moving in the direction that all the other yields were moving. This had a high of 5.55. Mortgage applications. This was the high on September 1st. These are mortgage applications up to September 2nd, so these rates were in that 1 week period, only a drop of 0.8. Refis down 1.1, purchase down 0.65. That's not, I wouldn't look at that and say, oh my God, look at the rates at which we're dropping. Last couple of weeks have been, they're negative, but they're not real negative. They're what you would expect with, maybe a small slowdown in the housing market. But the big moves, I think, and the big damage, I think, has been done. This is Realtor.com. This is year over year for the same week ending September 3rd over last year. And some of this can be a little misleading. Median listing prices are up 13.4% year over year. New listings are down only 6% versus being down 12%. Active listings up a little bit more, 27%, and pretty much the same as time on the market. If we'll look at the August trends, it gives us the whole month of August versus the last 5 years, as opposed to just 1 week over the same period last week. Last year was a ridiculously hot housing market. So we're basically comparing this week with a ridiculously hot housing market. It'd be nice to compare it pre-pandemic as opposed to using 2020 or 2021. Let's see how we stand up against 2017, 18, and 19. Okay, this is from Realtor.com. Link is in the description box. The August monthly housing market trends report. Number of charts to look at. Active listing count. Look at the change in slope here. And it was increasing rather quickly. And then, in August, we see a definite change in the slope. 779,000, which year over year, 26.6%, but you're comparing against a really, I guess you call it bubblicious year. Let's go pre-pandemic for the month of August. Look at the range here, 1.3 to 1.4 million pre-pandemic for those 3 years. Again, in a market that was already tight pre-pandemic, we're only at 780. Go to total listing counts. That almost went sideways. From July to August, pretty much went sideways. And now it is that time of year where seasonal effects will take a hold. If we look at pre-pandemic, it kind of went sideways over that period of time as well. So it's doing what it did pre-pandemic. But rates here, mortgage rates were super, super low. Here, they're very high. And, with prices being soft, you would think that, that might force more inventory onto the market, especially all the speculative houses that were bought. Maybe they have to go higher, sideways. So 1.3% year over year for total listing counts. This is sitting at about 1.3 million. This was up around 1.8 million. Pending listing counts. This is in some process of sale. It is seasonal as well. It tends to increase into the spring and then it decreases going into the winter months, and this has been decreasing, but you notice the change in the slope over here, right? Newly listed homes, that again is seasonal as well because it increases into the spring and early summer months and it drops off into the end of the year fairly consistently, drops off into the end of the year. But look at the rate of change down here. You can see the slope here, and we have a much sharper slope here for newly listed homes. So there's fewer that are coming onto the market. The next three are interesting. Days on market. It's somewhere over 40 days, 42 days versus 37 days last year. So it's taking a little bit longer to sell. But look at pre-pandemic. This is somewhere between 60 and 65 days. So we're some 20 days faster still post-pandemic where we are now versus pre-pandemic. Median listing price. This is what we're seeing is that prices have been coming down, and when we see this coming down, looking at, what effect does it have on anything else? Is it bringing more demand into the market? Is it bringing more supply onto the market? And the high mortgage rates are still keeping demand down, because otherwise we'd see the purchase index going up, we'd see the refi index going up. So we know it's keeping people out of the market, but it's also keeping sellers out of the market now because, well, I could have gotten these rates. Now it's down here. I'm not taking this. I want this. Even though if you look year over year, every single year it's been increasing and the spread year over year has been widening. Still, 14.3% year over year, which was, how much percent over the previous year, which was how much percent over the previous year, on and on. If you go back to 2017 in August, you're on the $280,000 line. This is 435 just 5 years later. This is the interesting one. This sort of cements it for me that more houses are just not going on the market or being removed from the market. This is the price reduced share, and it was really shooting up. This was consistent with people want to sell their homes before the price gets too low. There's going to be a lot of supply coming on the market. That will help fix housing costs. And it was shooting up until, nope, forget it. Look at it. It kind of just went sideways here. So again, that is consistent with what I've been hearing down here, is that sellers are just choosing not to list their home. So you're actually getting supply destruction along with demand destruction. So you're not changing the balance in the market between supply and demand. And if you need 1.5 million homes built per year, all the high rates are doing right now is lowering the amount of new homes built each year. So coming out of this, you're going to have an even greater housing supply problem. So I don't see housing prices slowing down, which means I don't see rents slowing down. And the belief is that the CPI report we're going to see on Tuesday will have a fairly good headline number, maybe even a negative headline number because of the flexible components, but that rent and owner's equivalent rent, which those two make up 32% of the core, will show month-over-month increases because rents last year were increasing. And rents are still increasing. Even month over month, they're still increasing because you have a tight housing market. Where are you going to go? Most of the apartment REITs, almost any apartment REIT out there has got an overweight, a buy, or an outperform rating on it. Very few have a sell rating. I don't think I've seen one with a sell rating. Some with a hold, but most of them are buy, strong buy, outperform, overweight in that whole sector. Because their rents are just strong. They can command those rents because where are you going to go? Higher rates are creating an even greater housing shortage. So I think housing is going to be a long-term bull market. And we'll look at the straddle that we had suggested last week, or was it 2 weeks ago? I forget. But we'll revisit that and we'll see how that one is paying off. Okay, I'm going to take you through a number of websites, and now all our Federal Reserve websites, well, except the first couple I'll show you, are not Federal Reserve sites. As far as the trade that I mentioned on the previous screen that I had highlighted, I think either last week or the week before, it was the HXB, the Home Builders ETF. I did a $62 straddle, which means you buy 100 shares for 62, and then you attach it with a sell the call, sell the put at 62, which gives me a $4 range for break even. So if it gets called away from me, it's a quick, for the time that I hold it, it's a quick 6.7 or 7% gain. And if I have to buy more, I buy them at a $4 lower price. They were September options, so they expire at the end of the week. And they're in the money right now per contract. That means per each 100 shares with the straddle in place, they're up 185. The most that they can be up is 400 because it's a $4 straddle. So if the HXB ends at 62, I make the maximum, which is 400. I still own the HXB. I'd probably close the options as opposed to risk any assignment over the weekend and do another straddle for October. But at this point, I think if I do it again, I don't think that I would sell the calls. I think I would go simply just to selling the puts on them because I don't mind increasing my position at this point. So going into expiration, if we're above 62, I'd probably close it so they don't get called away, and probably sell more aggressive puts for October because that shortage is going to persist, and because of the turn that I'm seeing in supply, I'm ready to increase my position. Let's go through a number of sites here. This is the Fed Watch tool. I've already shown you this before, so we can see exactly what we're looking at for September. This is the 75 basis point move. There's the 50 basis point move. If we move over to November, November has got most of the weight on a 50 basis point move. Because if we go back to September and we get 75, we're 300 to 325. A 50 basis point move would be 350 to 375. And there we are, 350 to 375, 81.5. So we're looking at a 75 followed by a 50. That's 125 basis points in those two meetings based on these bets right here. And if we go to December, the weight is on a 25 basis point move here, 71%, which is another 150 basis points from where we are now. So that short end of the curve is going to continue to increase significantly. So, the idea that being 16 basis points under the 10-year, that we've seen the high of the 10-year when the market is looking at a potential another 150 basis point move from where we are, that we're not going to budge that 10-year by 16 basis points? Come on. I don't think we've seen the high on the 10-year this year yet. And, we'll see how inflation rolls out on Tuesday. Again, not the Fed's preferred measure because it's prices, not expenditure. It's what prices are being charged as opposed to what prices are being paid. But the core is what we should be looking at, and we'll see if we can get any information on some of the sites that I'll show you. But I'm just going to go through a number of sites, especially for newer viewers who are not familiar with any of the sites. These are really interesting. You can click on any one of these for any of the meetings, and you can see what the dispersion in the probabilities are. This is the CME's Fed Watch tool. You can also look at the CME's the federal funds futures to see where the market has the Fed funds rates capping out. And the lower this is, we know it's 100 minus the rate. So when we see 96.01, that's 100 minus, this is basically 4%. So March 2023, we're still looking at 4%. This is 4.01, there's 4%, roughly about 4%. So it looks like the market is now anticipating that rates are going to rise to about 4%. And we don't see a pivot, we're seeing a pause. So this is, I think the fixed income market has it right. They're moving up to a target rate that's reasonable, 4, which from right now, from where we stand, that seems like a reasonable place to be. And they're pricing in a pause, not a pivot. Before, you could go out to April and May and you could start to see rates dropping right away. Well, that's a pivot. Well, you're not seeing that now. Even going out to August, 96.11, you're still basically hanging out about 4%. So, I think that has it right. Let's look at the Fed balance sheet. This is the New York Fed. All of these links are in the description box, and you can see the $4.2 billion drop. There is the total holdings, 8.3, and you could break it down based on T-bills, based on notes. It tells you the maturity date, so we can see what's maturing in September. T-bonds and notes. The ones that are maturing in September will roll off. So we can see exactly how much these 1, 2, 3, 4, the first 4 will roll off. And if you add them up, you'll notice that you can't get to 60 billion. Because you can't get to 60, you can back up here and you can say, well, some of these will not be rolled over as well. Floating rate notes. It tells you the next one here is October. So, if we're going to roll anything off, this won't happen till October. Treasury inflation protected securities. The first one is 2023, so nothing is going to fall off until 2023. The interesting thing here is I'm not sure. I think for this one, they keep adjusting the principal amount for inflation, because with Treasury inflation protected securities, you get a real coupon and then the principal is adjusted for inflation. So as you have inflation, the par value keeps increasing, and since this is listed at par, the value of these on the balance sheet will keep rising. So when we're looking at the decrease in the balance sheet from month to month, and we say, hang on a second, it doesn't seem like it's working out, we have to consider, well, how much did the tips category increase by because of the change in the par value? So that will be going up, which will add to the amount on the balance sheet, even though nothing was purchased. It's just the inflation protection component. You have agency debts, and here, well, we don't really know what's going to happen, again, because these are principal and interest bearing. Sorry, not agency debt, sorry, mortgage back. The mortgage back, we don't know what's happening here because this is principal and interest. And then you have some commercial mortgage backed securities as well. So there's a lot that you can do on this one. Let's look at the wage growth tracker. This is from the Federal Reserve Bank of Atlanta. Because there are sticky components of CPI, and it's believed that, well, wages are very sticky, and housing prices tend to have a sticky component to them as well. This is overall unweighted. It's a long time frame, so we don't get a lot of detail, but at the very end here, you have 3 months. At the very end, you have June, you have July, and you have August. So what we can do is we can highlight a certain point. Now, hopefully somebody from Atlanta Fed is watching and can actually send something to IT to fix this, but look what happens when you release it. You have your reset zoom button right over your chart. Right over your chart. So, that's a little annoying, don't you think? But anyways, you could just move your mouse. You could see, what we have here, June 6.7, 6.7, August 6.7. And then you could break it down, right? Let's go back to the where are we? Paid hourly overall job stayer, which is 5.6, 6.7. There's our job switcher up here. Look at that for switching jobs, 8.4. That's why you have a quits rate that's still over 4.3 million. This is why companies are having a hard time keeping employees because, if they stay, job stayers on average are getting 5.6% wage growth. Overall, we're at 6.7, but job switchers are getting 8.4. So if you can switch, you switch. And we've seen this before. You can click on any of these that you like, services, full-time, and you can get to full-time or part-time job switchers. You could break it down by industry as well. That's kind of a messy chart down here. Lots of good stuff that you can do here. You can play around with this, but the one message that's coming across is that you have this wage increase here. These are sticky. Now, when we say they're sticky, it's because they don't come down. They may go sideways, but they don't come down. One thing I'll point out here, and I know this is messy. Let's go just to overall, actually. Let's get something cleaner here. Unweighted series. Look at, this is 98 into 2000. This was primarily the dot-com boom. You couldn't hire IT to save your life, and so you took anybody and anything that could breathe and that even could recognize, oh, that's code. I don't know it, but that's code. Good enough, you're hired. You had a bit of a drop down here, and then you had significant a drop over here. This here is beginning to reflect the entry of China into the WTO, because prior to this point in time, I think it was 99 where they entered the WTO. So you had a downward pressure on wages, and then during this period of time, you could see that slowly increasing over time. I think that this is all gone. I think when you start talking about onshoring again, well, your wage component is going to increase, and since you don't have very attractive demographics in North America, in Canada and the US you don't, but Mexico does. So Mexico can really fill in the gap, and we're going to look at the Mexican peso, the performance of the Mexican peso, because I started thinking that if you can't fix the participation rate in Canada and the US, we have NAFTA. And if we're looking at onshoring, the Mexican government is not a dictatorship. It's a country we can do business with. They're a democracy. I don't know that we're going to have hostile negotiations with Mexico over the island of whatever, right? So it's got a small population, I think 180 million, which is 6 times bigger than Canada, but a little over half the size of the US, whereas China's got like 1.4 billion. However, wage rates in Mexico are cheaper than wage rates in China. Vietnam is the cheapest, but you still have an ocean to cross. So I think there's something to be said with Mexico. However, I still think that going forward, you're still probably going to have something like this in the range of 4.5%, 5% wage increases. So I don't know that this 6.7 will hold, but for those expecting to go back down to 3 to 4% wage increases, I think those are done. Okay, what else do we have? This is interesting. This is a Federal Reserve Bank of Cleveland inflation nowcasting. So there's August, which is the number that we're going to see for CPI, and they have PCE here. So CPI, they're with their nowcasting technique, which is kind of like GDP now from the Atlanta Fed. This is coming from the Cleveland Fed. 0.06, that's the headline. That's very benign. That's almost like 0% month over month. Is the market going to look at that? Or is the market going to look past it? Well, you got to look past two things. Number one, you got to say the Fed doesn't pay attention to CPI as much as they pay attention to PCE, and the Fed doesn't really pay attention to headline as much as they pay attention to core. So this is what we should be looking at, is the core CPI, and they're forecasting it to be 0.48. Isn't it nice that they have two decimal places? Isn't that nice? Instead of 0.5, it's not that much work to put an extra decimal place in, and look how much information I have there, 0.48. So if I annualize that, I get 5.9% on core. That's a 1 month annualized. That's way too high. That's way too high. You know that they're going, if that comes out, that should be a negative for the market. But are they going to attach themselves to headline, or is the market going to attach itself to core? Now, if you do get this and you sell off, it's because the market is paying attention to core. And then the next day it'll be, well, the Fed's going to have to pivot. I'm pretty sure it'll be right back. Or are they going to pay attention to headline and rally for the day, and then the next day say, but hang on a second, it's core that we need to worry about. I really don't know what to expect from the market. I really don't know. For PCE, headline 0.17, core 0.37. And if we annualize that number, what do we get here? We get 4.5%. Annualized. That's a 1 month annualized, which is a forward-looking inflation expectation. We expect that, well, let's take the 1 month and annualize it, even though it's not the best way to do it. We still get a number at 4.5. So yeah, these numbers here would support the Fed continuing to move forward. And we have September. Look at what's happening with CPI, the nowcasting 0.36. Because some prices are starting to move back up. We saw a little edge up in gasoline futures, heating oil futures. Saw a nice pull down in that gas though, but that makes up such a small component. Some of the metals prices are going back up. Some of the grains are going back up. 0.36. The core expected to be even higher for September, or at least the nowcasting. PCE higher, core PCE higher. And then you have the year-over-year change as well. This is a neat little chart which shows you how the nowcasting has changed over time. So it has been coming down. It's the green one that is the more interesting one. That's the core PCE. But that's sitting at 4%. It's been sitting at 4% for some time. Now, you want to talk about decimal places. There's 14. Okay, that's too much. I think we can all agree that's too much. Why can't they get it right? 1 is not enough. 14 is too much. 2 decimal places. 3 if you really, really feel the need to, but let's find some happy medium. Maybe we should start some kind of petition to get the economic data to be reported with at least 2 decimal places, 3 at the most, and then we can avoid this kind of nonsense. 14 decimal places down here. Maybe they said, you want decimal places? We'll give you decimal places. But it has been coming down. The flexible component has been coming out, which is what the interest rate works on. And it'll come down to the sticky component, and there I think is going to be tough to get that down. So these forecasts, and I've heard one saying, inflation is going to come right down to 0% by December, and we'll be looking at the specter of deflation early next year. The time series of core in history does not show that it comes out that way, hence the name sticky. if it did drop that quickly, it wouldn't be called sticky. There would be no name for it. It would it would all be flexible. That's why it's called sticky. So that's you can download some of this data here if you want to play with it a little bit more. This is GDP now from the Atlanta Fed. It gives you an idea of where it happens to be. Blue chip consensus we can see is 1.4. GDP now estimates are I think 1.3. Where are we? Yeah, latest estimate is 1.3 based on September 9th. And you have the subcomponent contribution charts. Can we get to that? There it is down here. So it gives you, the breakdown between consumer spending, residential investment, the exports, non-residential fixed investment, change in private inventories, and government spending. And my thought on the change in private inventories is that we do still have an inventory build, but because quarter over quarter the inventory build is lower than the previous quarter, it actually shows up as a negative. But if we look at consumer spending, it's fairly strong. I wish there's some way that you can get rid of this thing, because you can't scroll along here very effectively. So let's get rid of that. I just have to say, hey, look at the far right part of the bars here, and look at what's going on there. Consumer spending is the dark blue amount, and going into as we see. I have to move my mouse to show you here. September 1st all the way into September 9th. Look at how consumer spending has dropped off in each of these. We had 2.14 down to 1.34, 1.34 here, 1.15, and we're down to 1.15 on that. So you can play around on this and see what you like. Here's the changes in the subcomponent contribution. Lots of interesting stuff there. What do we have next? We have the Manheim used car index. This breaks it down year over year percentage change. Compact cars, luxury cars, mid-size cars. So you can see where the demand happens to be based on where what prices are higher year over year. Here's the index itself, so we can see that it has been coming down. Used cars, I think, make up 4%. Vehicles make up 8% of CPI, with used and new roughly at 4% weighting each. So over the month of August, that has come down. This is for August 2022, so we can see that that component of CPI can probably come in negative. Go back to Federal Reserve Bank of Atlanta. Sticky price CPI. This has a really great little chart down here if you're trying to figure out, well, what CPI measure would I use? So if we're thinking about real rates, and we want to use, for real rates, we're going to use the price index, not the expenditure index. We would deflate personal incomes by the expenditure index, not the price index, but for rates, we would decrease it by the price index. Which one would I use? And this gives you a whole bunch to use. 1 month annualized, 3 month annualized, the last 12 months, the core sticky CPI altogether. This is core and headline if there's any sticky components in headline. Flexible CPI and core flexible. So you can determine which measure that you want, and it gives you, I've got a number of them up here. So if we go right to July, because we don't have August numbers yet. Sticky CPI 12 month 5.8. The 1 month annualized is 5.2. The 3 month annualized is 6.8. And the flexible 12 month is 16.3. That's crazy, huh? 16.3. So when we are thinking about inflation, 1 month annualized is not really a perfect number to use. Well, there's no perfect number. It's not a good one to use because there is variability month to month. That the 3 month annualized is probably the better one to use, and our 3 month annualized in June was 6.8% on the core. The core sticky CPI 3 month annualized was 6.8%, and I think that's the number that we have to look at on Tuesday. Is what is the core, and then when this gets updated on the Atlanta Fed site, we can see exactly what it broke down to as far as the core. Okay, next we're at San Francisco here. PCE inflation dispersion. It's got some interesting tables here. This is the distribution of inflation. We can see the total. It breaks down in the core, and then the 10th percentile, 25th, the median, the 75th, and the 90th. And it gives the 10-year average over here as well. So we can see core inflation here, July, 4.562 versus 1.972 on the 10-year average. A little higher than what total inflation is on average. This is where it gets a little bit more interesting. The 10th percentile was negative 1.366. Now it's positive 0.575. So you can see at each percentile along the way how much higher it is. Median 5.9 versus 2.146. The 90th percentile 12.98 versus 4.4. Change in inflation. It gives different percentiles here. You have dispersion of inflation, fractions of items with price. When we have price declines, this is CPI. Expenditure over here is PCE. And then it talks about T declines and T increases. This is anything 2 standard deviations. So it gives fraction of items or expenditures 2 standard deviations below the average. So this would be below the average. This would be above the average. This is the fraction of items more than 2 standard deviations. This is below and this is above. Look how small that is, 1.96. And look at above, 30 for June and July, 37%, 31%. Coming down though, 39 to 37. This was 37 again, dropped to 31. And this is expenditures. This is prices. If we're concerned with CPI, it's the first 2. Skip over expenditures, it's the next 2. Anything with expenditure is PCE. So there's some interesting data here that I think, if you're interested in going a little bit further and looking at dispersion, some interesting stuff here. Okay, this is, I'm getting more and more interested in the peso. I've seen its price action for the year and it's been holding up incredibly. In fact, it's outperformed the US dollar for the year. King dollar, but maybe we should be talking about King peso. So this is a year-to-date chart of, we have the Mexican-Canadian, which is up here. You have the Mexican to the U.S., which is over here. And then you have the CAD versus the U.S. down here. Year-to-date down 2.92%, whereas the peso versus the U.S. is up 3.16%. So against the Canadian, it is up 6.26%. These are the bank rates, 3.25. Bank of Canada just raised its rate 75 basis points at 3.25. Mexico is at 8.5. So, I like the strength that I'm seeing in these difficult times, especially against the U.S. If we're onshoring and we're looking for a labor market, a younger labor market, Mexico is right there. I think out of all the car parts suppliers in the world, I think something like over 80% of them are already in Mexico. So there's already an infrastructure in place there. There's no ocean to cross. The border is right there. And they do have a younger labor force available. So if you're thinking about the Mexican peso outperforming going forward, 2 ways to play that. You can play it with Mexican government bonds, but you bring in default risk, and there is some default risk associated with bonds. I think their rating is, I think they have a BBB rating, which is the lowest of investment grade. Or you can use peso futures, and there I think you're going to have to call a dealer to get that done. They're listed on CME. There are peso futures. I don't find them in Interactive Broker, so I'm going to actually make a call. But long peso futures. How we get to the 6.26 from these numbers is quite simple. This is down 2.92%, so it is 2.92% over 1 minus 2.92%. Add back 1, you get 1.03. Take that, add 1 to the 3.16, multiply the 2, subtract out the 1. There's your 6.26 if you're wondering how to eliminate the US dollar in the middle of all that. This is year to date. And up to about this point in time, I'd say somewhere around here, they kind of performed in line with the Canadian, with the peso, and then they diverged from that point onwards sometime in May. Now, I've looked at the PMIs in Mexico. I've looked at the economic data. nothing. It's in line with what Canada's doing. It's fairly in line. So to have this kind of divergence is kind of a curiosity. I've been curious for a while as to why the Canadian is not getting very much respect. But the peso, I've been watching it all year, thinking, this thing it's holding its value, or it's slightly outperforming. And every time I see the Canadian weak, I look at the peso. It's not as weak, or it's actually up. So I think it's time for me to. I used to be quite interested in the peso because it had such a nice high yield. But I think now it's time to get back in, especially with the narrative of onshoring and the lack of the labor force necessary for, if you're going to bring back all those jobs, the lack of the labor force necessary, and the very low wage rates in Mexico, lower than in China. That it just seems to me an interesting place to be. There was also one report I read about energy, the cost of energy in Mexico versus the cost of energy in China, because China imports a lot of its energy needs. Mexico, well, has Pemex. Mexico has a lot of energy production on its own, that its cost of energy is cheaper than the cost of energy in China. So it seems like if we're looking for a low-cost place to produce that already has some infrastructure in place, Mexico seems like a great place for foreign direct investment. And maybe this is what's going on here, and that is not what is going on in Canada. The trade that I was talking about for the S&P, I'll explain it to you now. When I saw the rally last week, again, I have Bitcoin futures up on my screen, not because I'm interested in it at all, but it does tell me what's going on in the market in terms of who's playing. And because it rallied 10%, in my mind, the same playbook is playing out, that the retail market is still playing by the same playbook. So I know we're not in a new bull market. So I'm still on the not the bearish camp, but I'm not in the bullish camp, which means I'll sell rallies. So I did it with this one using October, and I used the 384 415 straddle. I sold the 384 put because I think anything below 384 that's interesting. And anything above 415, I don't mind being short. This was a nice setup because this one paid almost $12, $11.83, but we'll round it up to 12 just to make the math easier. So I got $12 for this. So what are my break evens? 42.70 on the index and 37.20 on the index, right? Being that SPY, if you take SPX and divide it by 10, you get SPY, roughly about 10. So 37.20 to 42.70. Well, on the last rally, the Fed is going to pivot rally. We got to just a little under 4,300. I don't know that we're going to get there again, being that the Fed has already bloodied a few noses on that one. And the last bottom that we hit was 36.66, so this is sitting just above the last bottom. So when I was calculating the spreads out and I looked at the break-evens, I thought, well, that kind of hits nicely. I'm just below the last rally, and I'm just above the last sell-off. That's a nice place to be, and these expire in October. And I put them on earlier in the day on Friday when I saw this going on. I thought, well, I'm seeing this Bitcoin rally. I don't like it, so I'm gonna stick that on there. I did a number of contracts on this one for October. Typically, I don't like to do things like this in front of big numbers like the CPI. I kind of like to get confirmation first about which way we're going, but I thought, well, based on what I'm seeing, I can't see anything above 42.70, and I don't think we're going to get below 37.20 based on the Fed moving 75 basis points, which is what everyone would expect. So I did that one. The home builder one, as I said, the HXB. I did the HXB, you'll recall, bought at 62, and then I immediately sold the call and the put for $4. So that gets me break even of 66. Well, it'll get called away from me at 66, or it'll be put to me at 58. I shouldn't say break even in that respect. I also did straddles on utilities and on healthcare. Those are paying off rather nicely, and those expire at the end of the week as well. So we'll see. Those are my long positions. This is my short position. Now, with this one here, I don't get much in terms of any real impact on DDB. Remember, that is a dollar delta beta. Is because I sold the put. Well, the put has negative delta. If you sell a put, you get positive delta. And here I sold the call. The call has positive delta, so when you sell it, you get negative delta. And I set it up such that these were each 0.3, as close to 0.3 as possible. So the delta on this is actually 0. So when you multiply this position by dollar delta beta, the delta, since it's very close and these are all multiplied, basically doesn't really add much. Not until it starts moving will it actually add something negative. So if the market starts moving up, this will automatically start adding negative delta. If the market moves down, this will automatically start adding positive delta. So it's kind of like a stabilizer on its own, which makes it kind of an interesting trade to have. And it's such a wide spread, I really had no choice to do it. Anyways, we're going to end here because there's not much to say. You've got a CPI report on Tuesday, followed by a Fed meeting 1 week later. That's all that's going on. No matter what is going on in the world, that's all that's going on right now in the markets. That is it. So I don't know that there's any point in focusing on anything past that. I've given you a bunch of really cool sites to go look at, playing around with some data, and yeah, we'll see you on Wednesday for the Q&A video.